Good morning, everybody. Welcome to our online class. Today, we'll be discussing much on conceptual framework. And even though we've started it before now, but probably we'll use this as an opportunity to more or less make some little revision, and probably start afresh so that the recorded version of this lecture can be listened to by students at their own convenience. And what we are going to do is, I'm going to refresh your memory from the beginning of the conceptual framework to where we stop, which means I'll rather fast track that. And once we get to where we stop, we can extensively continue. Welcome to class. And I think this will be the first class we have with respect to our virtual class. You are all welcome. And you'll find out that I've automatically mute all of you. And the essence is to get it coordinated and to limit disturbances, noise, and some other things. Now, the way it's going to operate is where you have a question or you have a concern, there are two mediums to which you can do that. But the most appropriate medium is for you to raise your hand. And to raise your hand, you go to the section within the Zoom where you can click raising up your hand. Another section is that, especially when you have questions as you move on, or you have concerns as you move on, and by show of your hand, I'm not able to spot it out, you can also send a message through chat. And if it's a question, I'll prefer you to send chat to everyone. But if it's something like a concern, probably you're having issues with hearing and some other things, probably you can do direct message. But for questions and other things that might affect other students, I'll prefer you chat everyone, okay? And that's how it's going to operate. And where there's a need to send documents in the course of this lecture, I'm also going to share it through the chat. But take note, if you are using phone, you won't be able to access documents via chat, except you are using computer. But as much practicable, any document we send via chat will equally be sent on your WhatsApp, the group WhatsApp for the class, which I've already reiterated and I've more or less sent some of those materials, okay? And if practically possible, you can put up your video to show your faces so that you can more or less mimic a live class, okay? And there are many beautiful things you could see as we move on this, where you could also participate by annotation, okay? But as we move on, we'll be familiar with it much more. And the beauty of it is that this is recorded in the cloud, and immediately after the class, it will be hosted and the link will be shared. I could see someone saying that permission to record this lecture is being recorded directly through the license and to the cloud. You are going to get it, which then means that you need not to bother yourself in recording the class. At every point in time, check if it is recorded. You will see a red button, sparkling light showing recording. Peradventure is not showing, please notify me so that I might do the needful, okay? Similarly to any other classes you guys have, just be observant about that so that you can call the administrator or the lecturer to question to be able to record it, okay? Thank you very much. I believe you guys are able to see my slides, okay? But it's going to be a mix of the presentation, which I've given to you as material, and also I'll do some writing, okay? As if I'm in the class, a board writing, okay? And that is that, okay? Welcome back again, and we can all start. Now, remember that we introduced ourselves to financial reporting. And the conclusion we reach at the introductory stage is that financial reporting represents a business language. That is the language to which business performance, business activity, operation, and of its sustainability are communicated to the users of financial reports. And there also, we said there are frameworks which serve as a structure that is expected to govern and direct the affairs of all involved in financial reporting in order to be able to achieve the objective. And I said this framework can come in two folds. The first fold is the regulatory framework, which we mentioned earlier about regulations that support the objective of financial reporting. And we've discussed that before now on both local regulation and international regulation. In Nigeria, we are all aware that the Financial Reporting Council of Nigeria, through the instrumentality of the Financial Reporting Council Act of 2011, is primarily saddled as the agency responsible for financial reporting and corporate governance in Nigeria. And by virtue of that, they oversee the affairs about ensuring sound and quality financial reporting. And I remember we discussed much more on FRC, its composition, its objective, its modus operandi, and of its directorates. Okay, we also went further to discuss on the international regulatory framework, where we also identify that the IFRS Foundation is an international body that is responsible for financial reporting and its principles around the globe. Okay, and we also ensure that we discussed on the trustees that is saddled with the responsibility of achieving the objective of the foundation. Furthermore, we discussed about the four organs or four bodies within the IFRS Foundation, starting with the monitoring board, up to the IFRS Advisory Council, up to the standard setting body, which is the International Accounting Standard Board, also known as IASB, and also discussed on the Interpretation Committee, which we call Ifrs. Okay, now we are now to move to the second framework, other than regulatory framework. The second framework is what we call the Conceptual Framework. The Conceptual Framework for financial reporting is more or less like a platform. It serves as the bedrock, as the fundamental guideline that supports all of our activities with respect to financial reporting. It gives us the basic principles and practices that we need to follow in ensuring that financial reporting objectives are achieved. And as I've said earlier, it's the foundation to which financial reporting and every standard that governs financial reporting is based upon or is referenced. Okay, and that is Conceptual Framework. Conceptual Framework is a document that's issued by the IASB. Okay, and of recent, effectively from March 2018, the framework was revised and rebuilt and reissued for use. And this framework has about 8 chapters that more or less serve as a guide to us as we move forward in our journey in financial reporting. Now, when you look at the Conceptual Framework, you can liken it to the constitution of a country. What does that mean? That is what defines what financial reporting is all about. The modus operandi of financial reporting and how financial reporting is expected to help businesses achieve the objectives, to help users of financial reports have sound judgment, and to also help regulators, auditors, and every other person involved or interested in financial reporting to have better appreciation, better understanding, and better use of the knowledge in interpreting, understanding, and trying to make effective decisions as it may concern individual stakeholders. And that is all what we need to understand about Conceptual Framework. Okay, and this is as issued by the International Accounting Standards Board. Now, The conceptual framework serves the following rules specifically as stated in the document. The first one we need to consider is that it assists the IASB in the future development of accounting standards. That's why at every point in time, standards are set in such a way that it draws its principles from conceptual framework, so that it aligns with the general principle of financial reporting as contained in the conceptual framework. The same way in Nigeria, where any regulation or any law or any act of parliament is to be enacted, it's always going to ensure that it's consistent and is in compliance with the principle and the spirit of our constitution. Similarly, that is what happens with respect to conceptual framework. Now, it also has continuously assists the standard setting body, which is the IASB, to carry out some level of harmonization of accounting standards, which also has assisted them in trying to have a level of convergence with other standards around the globe. A common one is the convergence program between the International Accounting Standard Body and the FASB, Financial Accounting Standard Board, which is that of the United States of America. And you find out that over a journey of 10 years now, there have been serious efforts to harmonize accounting standards such that the US GAAP is in alignment with international financial reporting standards. Also, one of the beauty of this conceptual framework is that it assists standard setting bodies in various localities. Like in Nigeria, remember we still have FRC as a standard setting body in Nigeria. If you are aware, Nigeria has its own standard prior to the adoption of Ifrs, and the standards are still in existence. And very few of the standards are still applicable, especially to small, medium enterprises and to areas to which Ifrs has not specifically addressed. And that standard is what we know as the Statement of Accounting Standard, which is SAS. Therefore, for every country that have their own accounting standard and they try to develop some standard by way of localization, they also use this conceptual framework as a basis such that the principles that governs all of what goes on in the standards are in alignment with the principles of the conceptual framework. Another thing there is that it assists preparers of accounts to have better understanding and appreciation and judgment in the course of preparing accounts, especially for structured transactions or transactions that specifically have not been more or less treated by any standard, or based on the uniqueness of those transactions, it requires further guidance in order to present them in a manner that represents the true picture. And therefore, conceptual framework plays a pivotal role in this process. Also, the auditors informing opinion, especially with respect to the judgments, to the basis of estimation and to the assumptions that are made by management of a company. What happens most especially is that the conceptual framework guides the auditors in forming their own independent opinion. And also, this is also appreciated by users of financial statements because it gives them leverage to having better understanding about the principle of financial reporting. And also it has assisted over time in ensuring that information contained in financial statements are more or less understood based on the principles of the framework. And probably finally, I could say it assists, or it is more or less a document that researchers or those that have special interest in financial reporting will more or less harness in gaining better knowledge into the affairs of the International Accounting Standard Board and on financial reporting principles. These are more or less like the common purpose or objective to which the framework is being developed. Okay. Now, what I wanted to do is to quickly take us to the chapters in the framework. I told you earlier that we have 8 chapters. And starting from the first chapter, which talks about the objective, of financial reporting. And financial reporting is a general purpose reporting. It's not entity specific, neither is it management reporting. This is what is meant for general users of financial statement, or those who can consider stakeholders of a business. Okay, the chapter 2 will talk about the qualitative attributes or characteristics of a sound and good financial information. And the third chapter talks about financial statements, its composition, and of which reporting entity are we talking about. The chapter 4 talks about element of financial statements, where we'll look at elements for financial position and also elements for financial performance, which represent measures of companies' activities and operation over time. Chapter 5 talks about the principle of recognition and recognition of items which constitute elements in a financial statement. And chapter 6 talks about how do we measure those elements in a financial statement, especially with respect to assets and liabilities. The other aspect is the presentation and disclosure requirement in financial statement, which more or less borders on chapter 7. And the final chapter will more or less take us to understanding and appreciating the concept of capital and capital maintenance. And these are all what we are going to discuss as we move on. As I have said earlier, the singular objective for financial reporting is the ability of the business to be able to produce financial information that is useful for the users of financial statements for decision making. That means the primary objective of financial reporting is to ensure that information is adequately and sufficiently communicated to users of financial report for decision making. And that is it. Now, various users exist, and various purposes to which decision is to be made equally exist, which then implies that we need to first of all appreciate that who are the users of financial information, who are the users of financial statements, or who are the users of financial reports. Now, for example, we could more or less summarize it by saying our users can be made up of external and internal. Okay, let me share my slide. The internal, I'll say the internal will be the owners of a business, especially for privately held businesses. We'll say the users are management, and the users, internal users, are employees. Let's look at external users. The external users start from the shareholders. Somebody might be worried to say, what's the difference between owners and shareholders? Now, owners is used with respect to privately held companies or businesses where it is owner managed. But for publicly held businesses or for institutionalized businesses, you'll find out that the shareholders are not involved in any way in the affairs of the business. For example, some of us are shareholders in companies like First Bank, GTB, and other companies like that. You are a shareholder. You are owner, but you have no involvement. Therefore, you are still an external in that perspective. And that's what we infer by that. Also, we have the following. We have our creditors, or what you call suppliers. We have our customers. We have our bankers. We have government and its agencies. We have financial analysts. We have researchers. We have potential investors, which include individual, private, and institutionalized investors. Sorry. Okay, we could have, let me say, the general public. Therefore, these are examples of users of financial reports, and they require the information contained therein for different objectives. Okay, one of the objectives to which the owner will be interested is to guarantee the efficiency of management, to guarantee that his business is profitable, and to guarantee that, or to obtain information on the sustainability of the business. The management is trying to more or less look at their profitability and performance over time in order to be able to more or less render their stewardship reports to the owners of the business. Employees are much more interested in order to support their wage requirement or demands, in order to also know whether the organization they operate, they work for, is a company that can sustain its operation over time. Okay, shareholders are interested in profitability, returns, and the sustainability of the business. Creditors are interested in ability for the company to pay back on their purchases credits. Customers are interested in ability for the company to continue to survive and be able to deliver on good products and services. Bankers are interested in it to appraise whether the capacity and the capability of the company support its demand for loans and advances. Government is interested in it for data and statistics, which is used by the Bureau of Statistics, is used by other government agencies, and primarily government also is interested for tax collections and some other things. Financial analysts are used to appraise investment viability in order to advise their investors on whether to buy company stock, to sell the company stock, or to hold on to the company stock. Researchers, probably students, MBA, PhD holder, and some other research institutions might need some of those information to draw up some conclusion about their research hypothesis or questions. Potential investors that are looking for opportunities also require financial information of companies in order to tap into the opportunities that exist in any company that is considered viable and sustainable. And the general public just want to have a fair idea of the company's performance and how that company has been socially responsible to its immediate community in terms of protection of environment, extending their more or less gesture to the community, and how they have been able to support the community as a whole through partnership with community, with governments, providing some social amenities and some other perks for the society. There are various reasons to which a stakeholder is interested in appraising the information contained in the financial statements. Okay, now that is about chapter 1. The next chapter we move to is chapter 2. And what does chapter 2 entails? Chapter 2 okay, I'll be switching, and I think you could see it now. Okay, chapter 2 more or less talks about the qualitative characteristics of financial information. Now, what it simply means is this. Financial information, for it to be useful for decision making, there are certain qualities and attributes that are essential to be present. Okay, similarly to you as an individual, not every information you come across or you come by that you make use of. You only make use of those information on the premise that those information are valid and contain some attribute that make you rely on it, which means reliability of that information is sacrosanct to you absorbing such information for decision making. And therefore, what are the attributes of a useful financial information for financial reporting purposes? We can group them into two. We have some qualities that are considered fundamental attributes. They are fundamental attributes because they underpin or they underline the acceptance of that information based on its reliability, which means those are the fundamental attributes that makes financial information reliable to any of the users for making decisions. Likewise, the other categories are factors that, though the fundamental exists, but the fundamental will not be able to achieve all of its goals if those other factors are not present. Which means those other factors, which are category 2, are what we consider factors that enhance the fundamental attributes. And to break it down, I'll put it in my notes now. The quantitative characteristics of useful information, financial information, we have the fundamental attributes, and we have other factors that enhance the fundamental attributes. I'll call this FA. Okay, now, what are these fundamental attributes? 1, relevance. And 2, faithful representation. Okay, now, when is information relevant? Information is relevant on the premise that it has the ability to influence decision. And 2, it is provided in a timely manner. Which is these 2 factors are prevalent in establishing the relevance of financial information to decision making. Any information that would neither give me a predictive value and or give me a confirmatory value will not be considered to be an information that can influence me or provide information to me in such a way that it will direct me in the course of making a sound decision. What it simply means is that if obtaining an information will not even change my mind, will not even make me to consider it at all, it means it has no ability to influence. But it has ability to influence if what? It can make me to have an input towards projecting about an affair that I might consider will be in existence tomorrow, and on that premise, I'm making that decision, whether to do it or not, it's relevant. Or is a form of financial information that more or less give me a comfort to which I have an earlier thought about, which means it's more or less giving me a backing to the thought and more or less the consideration I've more or less considered in the past of what will go into my decision making. In that light, we say such information provides confirmatory value, which then means that in that instance is when we consider such information to have the ability to influence decision making. Okay, second thing that is paramount is that such information is provided at the appropriate time, so that it is not belated. No matter how good information is, no matter the predictory value or confirmatory value of an information, once it is provided after the decision has been taken and it becomes onerous, it is no longer valuable or no longer useful. Secondly, information faithfully represents, given that the following exist. One, information that is free from material errors has some degree of accuracy. Such information will consider it to faithfully represent the facts. Information that is free from omission, we say such information is complete. And information that is free from biases, such information is considered to be neutral, which implies that information that is free from errors are considered to be information that depict accuracy. Information that is free from omission are information that is considered to be complete. And completeness is key in accounting. And finally, information that is free of bias is seen to be what? Neutral. These are the fundamental factors. Therefore, we can go down to appreciating other factors. Other factors that enhance the fundamental factors as follows. One, comparability of financial information is sacrosanct. And two factors measures how comparable the financial information is. The first one is issue of disclosure of financial information. And such disclosure or any aspect of financial information must be consistent. Which means consistency and disclosure of financial information is sacrosanct to guarantee comparability of information. Why comparability? Because in financial reporting, you require financial information for decision making. And you can't be talking about decision making if there are no at least two options in which you have to select one on the basis of mutual exclusivity. The question then is, if you are making a decision, it means you have at least two options, whether yes or no. The question then is, how can you make decision and mix options if those options have no basis of comparison, which means comparability must precede your choice in early decision making. And financial reporting must guarantee such comparability, such that you are making decisions on the basis of comparing apple with apple and not apple with orange. Okay, second one is the timeliness of information, which corroborates what we discussed under relevance. Ability to influence decision making is sacrosanct, but how timely it is provided is equally important. The other aspect is verifiability, as we have said. Verifiability means ability to have evidence supporting a financial information before it's being relied upon is essential. And verifiability means that how do we verify such information to be valid? There are two mediums to which such is done in practice. There's what we call direct verification. Direct verification is documentary in nature. You can do direct verification by way of citing documents to establish the genuineness of the transactions and information. It could also entail physical inspections and some other things, which means this is evidential. And that's what we call direct verification. The other verification that could take place is indirect verification. What does that mean? Indirect verification implies that you are more or less intuitively trying to appraise the judgment made by management, the assumptions made by management, the estimation made by management. For example, a company that is into transportation bought transportation vehicle and it says the useful life is 8 years. The question is, IAS 16 has required that the useful life or the pattern of usage influences the useful life of an asset, which means having the same car, buying it at the same time, at the same price, with the same quality, does not necessarily mean the useful life will be the same. Because one company might buy the car for executive use. The other company might buy the car for staff transportation. The question then is, the car that you use for the MD as executive is less driven than the car you use similar to staff conveyance. What it simply means is that the rate of usage will affect the useful life of any car. The question then is, what is the reasonability of the 8 years you have chosen? And that is to ask yourself a simple question. Is this the first time the company is buying a car? If the answer is no, the question then is, those cars of similar nature and use bought in the past and deployed in the past by the company, what has been their average years? If the company has not done it before, let us look at similar companies or similar use of car, and for the location you are talking about, how often do people replace? All of these are intuitive way of indirectly verifying the validity of a financial information. And finally, a financial information must be capable of being understood, which means understandability is key in financial reporting. Now, the first thing is that the information you presented to users of financial statement, the first thing you need to consider is to consider the capabilities of the users. That is why you find out that IS1 standardizes the presentation of financial statements so that it has considered in the simplest form to which financial information can be presented to the general public, to which average user have a better understanding and appreciation. And that is why that was standardized. That's why when you pick any financial statement of companies, you find out that they are more or less the same. The only difference is the numbers and some other relevant disclosure. okay? Or because we don't want people to unnecessarily incur avoidable costs in trying to understand every bit of financial statement they lay their hand into, especially for investors that have investment in scores of entities. And secondly, you must simplify the information contained therein, which means when you are presenting financial information, such information must not be full with jargons. Jargons means that full with a lot of terminologies. Remember, more than half of users of financial reports are not accountants, or they might not be financially inclined. Therefore, you must present information in a manner that they can understand in simple terms. Okay, and presenting information in simple terms means you present it in a granular level, in a basic language that is understood. I recall again, Conceptual Framework is not interested in the language to which you present your information. It's only interested in the simplicity and orderliness of that information, which means if you present your information in English language, it must be simplified in terms of what can be understood by an average person, so that where you have terminologies that you have to use, such terminologies have to be explained in the basic term. For example, you are making reference to the fact that in this year we have written down our assets to the tune of 10 billion because of an impairment and also of things. The question is, how many people understand the word impairment? But after that, you can simplify that the impairment is as a result of the fact that coronavirus impacted our operation, the fact that dollar has lost its value, the fact that Nigeria economy has experienced a drastic recession. And so, it's just for you to explain so that people, a common man, understand what you are talking about. You are not necessarily communicating to somebody that is financially inclined like you, but rather you should have it at the back of your mind that your communication is to the general public. Okay, and that is that. And that speaks to chapter 2. Okay, now we'll go to chapter 3. You can read more on chapter 2. You already have the materials, okay? There are further explanations I've made with respect to that, with scenarios, in addition to what I've discussed. Now let's move to chapter 3. Now, chapter 3 talks about financial statements. Now, what is a financial statement? Financial statement is simply the vehicle. It's simply the what? The vehicle that conveys financial information to the users of financial statements. Now, remember, I think I mentioned it in class, that don't get to the exam and say it's a vehicle, okay? Or rather, instead of using a vehicle for conveyance, you say is a statement or document that conveys financial what? Information, which means financial statements that conveys financial information with respect to what? Financial performance, financial position, and the cash flows of a business to the users of financial what? Information. Now, that is financial statement for you. Financial statement is a medium for communication, which means I can equally say is a medium for communication of financial information to the users of financial reports. Now, let me show you what I've written. This is what I've written so far. I said financial statement is a document that conveys financial information with respect to financial performance, financial position, and cash flows of a business to the users of financial information. Similarly, I can say it's a medium for communication of financial information to the users of financial reports. Okay, that is that. Take note, this is my note or my board. I'm going to share it with you guys at the end of the class. Okay, now let's go back to that. Now, financial statement has variants. I can say forms or variants of financial statements. Now, financial statement will come in form of unconsolidated or simply put, single financial statements or simply put, financial statements. What it means is that you are talking about financial statement of a single entity. Financial statement of what? A single what? Entity. That is simply as unconsolidated, which means it's just for one company. Or simply put, when you hear unconsolidated financial statements, or when you hear financial statement, or when you hear financial statement of a single what? Entity, it all means the same thing, which is you are talking about financial statement of White Associates as a company. But you could also have consolidated financial statements. Consolidated financial statements are financial statements of a group. Is a financial statement of a group. What does that mean? Later on, which is the next topic we'll be moving to, a very long topic for that matter, is group accounts. Now, financial statement of a group implies that this is a financial statement of at least two entities, if not more than two, that constitute a group. And the word group means that it comprises of an entity known as the parent and an entity known as the subsidiary. And we're going to see that later. The uniqueness of this is that these entities have relationship with respect to investment by one in another. The parent is said to have investment in the subsidiary so that the parent has a control over the subsidiary. And such, when we have such in any situation, we say the two entities are members of a group. Okay, and in that regard, based on the requirement of IFRS 3 and IFRS 10, we are required to combine the account and continuously at every reporting date, provided such relationship holds, we are going to consolidate the account, which means consolidating the account means that you infuse the two accounts together and present it as if it's an account of a single entity. And that's why anywhere you come across consolidated anything, you must understand that it is not of a single entity. It's of at least two entities that belong to the same group. And one automatically will be parent, the other will be the what? Subsidiary. We'll get to know this more as we move on. The third one is a combined financial statement. The combined financial statement shares similar principle with the consolidated. The word combined means you are not talking of one, you are talking of at least two or more. Therefore, if you have two or more entities that are owned by a particular individual or set of individuals, remember, I use the word individuals, I didn't use the word entity. What it means is that, let's pick for example, I'm wealthy. I own Wise. I own another company, about 2 or 3 companies like that. Now, as an individual, I want to see the collection of my businesses and see their position, their performance as a whole, which means the 3 businesses have no stake in another. They are just separate businesses. The only thing common to them is that I am the owner of business A, I'm the owner of business B, and I'm the owner of business C. Now, individually, I have the financial statement, but I just want to see that at any point in time, I want to see the global picture, the glance of my businesses as a whole. Therefore, I now decide to combine the results, combine the assets, combine the capital, combine the liability, combine the revenue, combine the expenses, and say, okay, for my group of companies, not a group now, but what? Group of what? Companies that are under my ownership as an individual, I want to see their financial statement as one. That's what we mean by combined financial statements. When we get to consolidated financial statements, I'll further explain the thin line between the two statements. Okay, but I'll give you a small hint about it. In consolidated financial statement, the equity of subsidiary or subsidiaries will always be eliminated, which means the capital you are talking about must only be the capital of the parents. But in a combined financial statement, there's no elimination of capital because the sum of all of the capital is what makes up the capital investment of the individual owner. When we get to group account, we'll demystify it over time. Okay, which means 3 forms of financial statement is what you can come across. On consolidated financial statement, which is for a single entity, consolidated financial statement, which is for a group, and combined financial statement, which is for the collection of businesses owned by an individual that wanted to see the picture as a whole. Now, but financial statement itself, regardless of whether it is consolidated, whether it is unconsolidated, or whether it is combined, they all have 5 components, which means we'll talk about components of financial statements. One is statement of financial position. Which some people will call balance sheet. The standards still warrant you to call it balance sheet if you decide to choose so. The second one is the statement of profit or loss and other comprehensive income. Some will call it statement of comprehensive income, which is a two statement in one. I think you'll have discussed that under IS1 if you've started. Other people might see it as statements of financial performance. Now, I said it's two statements in one. The first statement is statement of profit or loss. The second statement is the other comprehensive income. Now, if you have no other comprehensive income, you might likely call it in a simple term, income statement. Which means anytime you see income statement, it means they are only talking about the section of statement of profit or loss, and simply put, because there's no other comprehensive income. Okay, third, you have statements of changes in equity. Okay, some people will see it as statements of changes in net worth assets. And as we move on, you'll see what we mean by that. Okay. Another one is the statement of cash flows. Even though some people might call it cash flow statements, okay, but we barely use that terminology. We always try to start with statement. The same way some of us try to avoid income statement because we prefer to use the statement of to describe. Okay, and finally, we have the notes to the financial statements. And these notes can be broken down into the following. The first thing you need is the general information. About the entity. The second thing you need is to have a statement of compliance with IFRS. Is a given. This is by way of the introduction of IFRS by way of adoption. IFRS 1, first time adoption of IFRS. Okay, which means every financial statement you pick must have that statement. Okay. Also, another one you could have is reporting period. Must be defined. Which year are you reporting and for what months? Are you reporting for 12 months? Are you reporting for more than 12 or less than 12? Remember, your reporting period usually should be 12 months. Similarly for your comparative period. But there are exceptions to the rule, which can be less than 12 or more than 12. Less than 12, probably you are just commencing business, or you are changing your accounting year end, or there's a structural arrangement where it leads to acquisition or merger, where within that period is not up to a year. And it can be more than that as a result of the same thing. You are commencing business, let's say October, and your year end is December. Instead of doing 3 months, rather wait for the next year to do 15 months. One thing that is paramount is that you can't do financial statement that is less than 3 months, and you can't do that is less than 18 months. Okay, that is greater than 18 months. Therefore, that is that, which means you must define your reporting period and you must define the periods in that accounting year. Okay, similarly for its comparative periods. Okay, another thing you show in it is to show management judgment, assumption, and basis of estimation. You know, IFI talked about fair value, I talked about evaluation, IFI talked about impairment, talks about making accrual provision. All of these have some level of subjectivity with respect to the judgment that has been taken by management. Like example of useful life of assets I've talked about, the assumptions that have been taken, and also the basis of estimation that has been taken by management. Thereafter, you talked about the accounting policies of the company. Thereafter, you have analysis or notes to accounts, or what called the line what items in the financial statement. For example, you start to have a breakdown of your revenue. What is the composition of your revenue? You have the breakdown of your cost, like cost of sales. You have the breakdown of your administrative and management expenses. You have the breakdown of other income. You have the breakdown of your assets into various PPE. We have the schedule to break it down into motor vehicle, property, and etc. Inventory to break it down into the categories of your inventory. Receivable to break it down into third-party receivable, intercompany receivable, and also of things like that. All of this breakdown constitute your analysis or notes on the account. Thereafter, you have disclosures. And the disclosures varies from operations, varies from financial risk management, varies from capital management disclosures, and any other disclosure that is considered necessary. And I can come here and say other disclosures. Okay, what I can do now is to, depending when you look at this, is to try and get a typical, okay, let me try and get one account as you are looking at this to share with you guys. Okay. I've downloaded it, and okay, can you see it? Now, if you read my material, you'll find out that I make mention of something there. Okay, where I discussed about financial report, how it differs from annual report and how it differs from financial statements. Okay. If it's not here, probably I'll share the material with you. Okay, I think it's not here. Okay, I'll share it with you. Now, let me just explain what I mean. Now, annual reports include financial statements and every other report, statutory report, and company-specific reports, which means everything you see here is annual reports. But financial statements only start from those statements I mentioned. Can you see it here? Like this statement of financial position, statement of profit or loss, statement of changes in equity, cash flow, and the note. This section from 66 to 73 is what constitutes financial statements. So that any other thing outside that are requirement of CAMA, the requirement of industry they belong, and the company's own specific information charter that they provide to the general public. Okay, now let's go to this section. Now, you can see consolidated, and they put separate. Separate means that they are not only showing consolidated, they are also showing for the parent company, which is separate, okay? But what we are interested in now is the financial statement. You can see the financial position, okay? And you can see the statement of profit or loss and other comprehensive income, both consolidated and separate. You can see the statement of changes in equity. Let me rotate it so that you guys don't bend your heads. Okay? And you can see cash flow. Let me return it back. You can see the statement of cash flows. Now, where I'm taking you to is a note to the financial statement. You know, I do make up a breakdown by saying general information, statement of compliance, and everything. I want to show you here. Now, this is general information about the entity. You must let us know which entity are we preparing in financial statement. In this case, it's said to be Flour Mill of Nigeria PLC. The company was incorporated in Nigeria as a private limited company on 29 September 1960 and was converted to a public liability company in November 1978. It is registered. Its registered head office is located at 1 Golden Penny Place, Apapa, Lagos. The financial statement comprises of the company and its subsidiaries. Now you can see principal activities of the company. Now, part of information you provide issue of general going concern and all of other information which you are going to see. Now, thereafter, they put up the structure. Those are still generic information about the entity. Now, what is paramount here is you saw something about reporting period. Can you see? You must state your reporting period and of the comparative. What year are you reporting? Now they are reporting 2020. you now be shocked that our 2020 has not ended. But by the time you read it further, you learn that 2020, the year end is March. That's why they said here that this consolidated and separate financial statement cover the financial period from 1st of April 2019 to 31st of March 2020, with comparable for year ended 31st March 2019. That is the same thing we are talking about. Now, you saw statement of compliance. You must compulsorily, once it's omitted, such will not be considered IFRS financial statements. The statement of compliance reads as follows. The consolidated and separate financial statement has been prepared in accordance with the International Financial Reporting Standard issued by the International Accounting Standard Board and the interpretations issued by the International Financial Reporting Interpretation Committee and the requirement of Companies and Allied Matter Act, Cap C20, Laws of the Federation of Nigeria, 2004, and the Financial Reporting Council of Nigeria Act, 2011. Now, basis of preparation of financial statement, you must tell us what pages have you used. I remember the convention is historical cost basis, but today it is subjected to fair value adjustments, such as items that you fair value, whether they are biological assets, whether they are investment property, whether they want to use valuation method like PPE, whether they are financial instruments that are measured at fair value, and etc. Before we now come to the statement of Synchron accounting policies, where you discuss all of your policies that governs your accounting. Okay, these are your policies. Thereafter the policies, what is next is significant judgment, assumption, and sources of estimation by management. You saw it here, which is key to what we have discussed. Management has made some judgment to say useful life of asset is 10 years. How did management come about this judgment? They have to tell us that, okay, these vehicles are going to be driven in FCT. People have a reason for that to say, okay, it's 10 years. But if you say they are going to be driven in Ajegunle, in Lagos, you ask yourself, which of the Ajegunle? Is it that Ajegunle exists in Banana or Ikoyi, where you have good roads, or the same Ajegunle that we know that a new car in 1 year is like a car of 10 years? Do you get what I'm saying now? You provide us basic information about the judgment you have made in the course of preparing this account, the estimation you have done, and any form of assumption. Before you now get to, you now see what I'm talking about. Yeah, I've gotten here. Okay. The note on the account in terms of analysis, what is the source of revenue? Revenue from customer to customer. They render services and they also sell goods. How much have they made in each line? They broke it down into various segments. Likewise, the cost of sales. Okay. Now, net operating gains, they broke it down. What are other incomes that you have made? From what source? They broke it down. The selling expenses and distribution, they broke it down into those ones that serve as commission, which is employee related, those ones that are advert, and those ones that are selling expenses. Administrative, they broke it down into auditor's remuneration, bank charges, legal fee. All of these are what we talked about. And finally, you come to disclosures. These are still breakdown. Now you come to disclosures. Now you go to disclosures. The first one is that you are disclosing information about your dividend, disclose information about, okay, related parties. Okay, who are your related parties? What kind of transaction? What is the balance held? What revenue was made? Director's remuneration. Financial instrument disclosure with respect to financial risk management in terms of your market risk analysis, your liquidity risk analysis, your liquidity gap, your credit analysis, and other things, which are going to discuss when we get to financial instrument disclosure, IFRS 7. Capital management, capital risk management disclosure. You have disclosure about it. How have you been managing your capital, which is also with respect to capital maintenance concept we are going to discuss as we move on today. Your financial risk management with respect to credit risk, market risk, liquidity risk, and all forms of risk that the company is exposed to. All of these are what are contained in the financial statement. Any other thing that you find in an annual report is not a financial statement, because financial statement is just a section within an annual report. Annual reports includes statutory report, financial statement, company-specific information, industry-specific information, and regulatory-specific information. Does that make sense now? Okay, that is that. And that's the beauty of this virtual class, whereby things you cannot easily share in class, you can easily navigate them in a virtual class. Okay, that is that. We can go back to our material. Okay. Okay, now key considerations. Frequency of reporting, I've discussed that. Comparative reporting, we've discussed that. Event after the reporting date, you are still going to discuss that extensively under IAS 10. Okay, what that is saying is that certain events occurs after the reporting date, but before the financial statement was authorized for issue. Such reports have to be, such events have to be analyzed into those that qualify as adjusting events and those that qualify as non-adjusting. And that will be discussed as a standard under IAS 10. Okay, but let me give you a practical example. You will find out that COVID-19 happened in Nigeria. Lockdown started in March, even though the first case was on 1st of March or 2nd of March. It was first week in March. The first index case in Nigeria was announced. Okay, now many companies have their year end as at 31st December, but they've not issued account as at the time this became prevalent. The question then is COVID-19 pandemic event an adjusting event or not? For companies that had their year-end December, it is not adjusting because it was not evident as at December. Okay, it only occurred with respect to its activity by way of declaration as a pandemic by the by the World Health Organization in January. Therefore, it's a non-adjusting event. But for flour mills that its own year end is 31st of March, as at 31st of March is already a pandemic anywhere in the world, which then means that to to flour mill is an adjusting event. And that's why you find out that in flour mill accounts, there was a disclosure on COVID-19 and its impact in the account. You see it here, COVID-19 response. Let me see what was stated there. Okay, this were the CSR, okay? You can read more of that. Yeah. Okay, now let's move back to our discussion. We'll go back to chapter 4. I think we've finished with chapter 3. I'm going concern assumption. Okay, let me speak on this quickly because we also read it in the disclosure of flour mill. Now, all of this presentation is on the premise that the company is a going concern. It means a going concern assumption says that this company, for the foreseeable future, as evident by management and its judgment, will continue to operate as a sustainable business. And on that premise is how we prepare account on a going concern. But peradventure, this is impaired or can no longer hold. Our basis of accounting will have to change. And we have to refer to IAS1 that gives us alternative basis such as breakup value basis. Okay, and I think you discussed that in IAS1 when you are discussing presentation of financial statements. Okay, now chapter 4, element of financial statements. Now, element of financial statement can be subgrouped into two. Those that is identifiable with financial performance and those identifiable with financial position. Now, for financial position, we have three elements, namely assets, liabilities, and equity. And for financial performance, we have it as income and expenses. Now, let's start with this. First thing is that assets can be likened to economic resource, while equity and liability can be likened to claim, because anyone that put his money in another company is either the other company take it as liability or as equity. Regardless of it, everybody that put money somewhere expected the money back. That is why the standard, the conceptual framework define liability and equity as a claim. Okay, but claim on what is what makes the difference. Now let's start with the assets. Now, asset is not about how tangible it is. It's not about what physically we can see. It's not about physically its weight, not about physically its height, not about physically how it shines. But what matters about asset is that it constitutes both tangible and intangible. That is, any form of resource which we can classify as economic resource that we already possess, whether by way of having control over it or by way of ownership of it. Any resource of such that we have and we control such resource towards ensuring that benefit accrues to us, such must be considered as an asset. And that's why we describe it as a present economic resource that is controlled by an entity as a result of past events. And I'll break it down into those factors you need to look for. Similarly, liability, we said is a claim. But a claim of what? Is a claim over the assets of a company. Whereas equity is a claim over the net assets. One is claim over the asset, which means by the time you default, the asset will be used to settle it. But the other one is a claim over what is left, which you call net asset, which means net asset means you have already settled all of the liability. What is left is residual, which belongs to the equity holder. That is why we define liability as a present obligation of the entity to transfer economic resources as a result of past events, which means asset brings about inflow of economic resources. Liability brings about outflow of economic resources, whereas equity, though, is a claim over the net asset. It is simply seen as the residual interest in the asset of any company after all of the liabilities has been settled or deducted. Okay, now later on you now find the reason that equity only is measured once in its lifetime, whereas assets and liabilities are subjected to measurement over their lifetime. But equity is only measured at the entry point. And subsequently, it's not a measure because it is the residual, which means it is what is left of your asset after your liabilities have been deducted. Similarly for income. Income for financial reporting purposes is not necessarily until you carry out activity. But income is anything that brings about increase in your assets or brings about what? Decrease in your assets, which ultimately results in an increase in your equity other than you considering the effect of new capital being contributed by the owners. Let me simplify. What it simply means is that whenever you find out that your equity has increased in value, and it's not increasing because you have contributed new capital, but it's increasing because during that period, your asset has increased in value or your liabilities has decreased in value. Therefore, we say you have earned income. And what could bring about that in practical sense? One, when you sell goods, okay, you make income. That's one. Two, when you render services, you make income. That is two. There are situations where you don't sell goods, neither did you render service, but you are passive and you still make income. How possible is that? Imagine you have in your bank account, part of your cash balance as a company is dollar. And when you bought that dollar into your domiciliary account as a company, you bought it at 360. As at last week, we are all aware that dollar rose to 500 naira, which means without doing anything as a business, you've earned income by way of foreign exchange gain of how much? About 140 naira per every dollar you have in your account. That is an income. If your company has shares in GTB, you bought the shares when it was 25 naira, but it rose at a time to 38 naira. And as at yesterday, it was 34 naira. The question is, have you done anything by selling goods? Have you done anything by rendering services? But mere holding an asset that increases in value, you have made what? An income. Similarly, when liability reduces in value, you might make an income. How? If you have a liability that you are supposed to pay in dollars, you imported goods in dollars, you have to pay your foreign supplier in dollars. When you imported the goods, naira to dollar, if you are paid immediately, was 500 naira to dollar. But now, today, you want to pay. Because of CBN intervention through the window that says the Ifrs fund can now be taken back in dollar and sold at anywhere you want it. That has forced naira to wax strong than dollar. As at yesterday, naira has gained against dollar to the rate of 460. Which means if you are now today to pay your obligation, instead of before that you will have demanded for 500 naira to pay your $1 obligation, you are now demanding for what? 460 to pay that same $1 obligation. Have you gained or not? You've also earned income by way of reduction in liability. Which means income is not by way of activity, but is a collection of activity and events that have brought about accretion in your assets, increase in your asset, or a reduction in your liability, other than you injecting your capital. Finally, we'll talk about expense. Expense and income can be classified or categorized as changes in economic resources and claim, which impact equity, and that is used as a measure of financial performance. Now, reverse of an income is an expense. Remember, income brings about increase in equity, but expense will bring about what? Decrease in equity. Income brings about increase in equity because asset is increasing or liability is reducing. Expense is bringing about decrease in equity because asset is reducing or decreasing, while liability is what? Increasing, without considering the impact of distribution made to equity participants. What it simply means is this: whenever your equity is increasing and it's not is decreasing, and it's not decreasing because you have paid out dividend, whether as stock or as cash or anything to your shareholders, but the equity is decreasing because your asset is reducing in value, or your liability is increasing in value without you borrowing, Therefore, you have more or less created an expense. Practical example is this. You can create expense to your activity. 1, you bought goods. 2, you enjoy services. You pay for them. These are expenses. But expense can also arise. Imagine your assets suffer an impairment loss. Your assets suffer damages. Your assets suffer depreciation. The question is that without any activity, you still incur expense. What about your dollar account? You bought dollar at 500 naira. Now today it is 450. By the time you see the value of your dollar in your account, you have already lost 40 naira. That 40 naira is as a result of events independent of your operation, which is also a loss. And a loss qualifies as what? An expense. And that's what we are talking about. And that is what we need to resonate with when we are describing elements with respect to assets, liability, equity, income, and what? Expense. Don't let us see it from the angle of primitive idea or of what is tangible in nature. As I always say, when you pick the biggest 5 companies in the world, their bulk of value is created by way of intangibles. All of them are tech companies. And is their intellectual property, is their development in terms of research and development, and all what they have turned around in terms of patent is what is giving them that leverage or edge, which goes beyond physical. Go and check companies that have much of physical assets. Oil and gas companies, manufacturing companies, they are nowhere to be found in the list of big companies because tangible assets has limitation in creating wealth, unlike intangible that could create massive wealth beyond what you expect. Okay, now that is that on the element, but you can read further on it. As I said earlier, 3 attributes are key in identifying what an asset is or what qualifies an asset. 1, you must consider the right you have to the economic resources. Okay, 2, you must consider that those economic resources have potential of generating economic benefit to the business. And 3, you must have control, and your control is gained because of your past events. Okay, and you can read more about right, control, and potential, which I've broken down in my material. Liability, as I've also said, also have 3 attributes. 1, it must be an obligation that is present. Now, obligation that is present means it must be contractually present, or it must be contractually present, or it can be constructively present. Contractually present means that by way of contract and by way of performance of a contract, you are obliged and indebted to make settlement by way of transferring your economic resources, be it cash or any other form of financial asset or assets. Or it can be constructively obligated, which means by way of your valid expectation, by way of your pattern of past practices, that obligation exists on you. Okay? Second one is that potentially you must be able to result in an outflow embodying economic benefit, which means liability is liability because it requires settlement, whether today or at a later date. But any portion of a liability that no longer requires settlement is no longer liability, and by the time we get to chapter 6, we'll talk about the recognition. Therefore, you appreciate better of what it means to recognize a liability. Okay, and thirdly is the issue of present obligation existing as a result of past events. Anything you call your asset or liability must arise from past events. That is why you find out that contingent assets did not arise from past event, but is expected to arise from future events, and therefore it's not an asset. That's why I call it a contingent asset. Not an asset for accounting purposes, just for mere disclosure where necessary. Similarly, liability that is not of present obligation, but rather they are possible obligations or obligations that are expected to be determined based on future occurrence or non-occurrence of an event is no longer considered as a liability. Rather, is a contingent liability, which is not a liability. At no point is contingent liability a liability unless it crystallizes. Okay, that's why we only disclose it when necessary. Okay, equity, as I've said earlier. Now, equity represents, I can break down your equity into various forms like this. Your equity is simply your asset less your liabilities. Where you don't have liability, your equity equals your assets. But where you have asset and liability, your equity is expected to be positive. And it can only be positive if your asset is more than your liability. But there are situations, even though rare, that your liability might be more than assets, which invariably make your equity net of a liability, which means it's negative. Now, when asset is more, we call it net of assets, which is net asset for equity. But when it is negative, we call it net of liability, because it's net liability equity, which is negative. Okay, take note of that. And that's why we said that equity is the residual interest in the asset after deducting liabilities, or the residual or claim over the net assets of an entity. And remember, equity has its own component. It can be grouped as follows. Equity starts from your share capital. This is your statutory capital. Okay? That's why we always tell people that equity is not the same thing as capital. Capital is a component of equity. Okay? Other components of equity are reserves. And from my own understanding, reserve can be grouped as follows. You can have capital reserve. There are other forms of regulatory reserve other than share capital. Okay, take note. Any other form of reserve that are regulatory reserve other than what? Capital. And it is industry based. For example, in bank, you create credit risk reserve, which is compulsorily required by banking regulation. You create reserve for what's it called? Statutory reserve. It's also banking regulation. In insurance, you have contingency reserve. All of those ones are regulatory reserve that falls under capital reserve, other than your actual share capital. Now, but the one common to financial reporting is retained earnings or accumulated losses. Retained earnings, usually when it is positive, accumulation of your profit over time that is not distributed. While accumulated losses is usually for those that are losses over time that has eroded your earnings. Okay, other components of equity are related to any other reserve for financial reporting purposes that is created separately from retained earnings. Example of that is revaluation reserve is created as a result of revaluation of asset that passes to other comprehensive income. Fair value reserve is created as a result of item that passes to other comprehensive income with respect to measurement of financial assets as fair value to OCI. Actuarial gain reserve or loss is as a result of actuarial measurement in line with IAS 19, employee benefits, which also passes to other comprehensive income. Cash flow hedge reserve is as a result of you adopting a voluntary accounting of hedge accounting under Ifrs 9 for cash flow hedge. And that is also passes to other comprehensive income. These are specialized reserves other than retained what? Earnings. Okay? We've discussed income. Now, income comprises of revenue and other income. Revenue simply means your income derivable from your principal activities of your business, which means what you do as an entity. Any income generating from what you primarily do as a business is your revenue. Any other income other than that is other income, which means your interest income, your gain from disposal of assets, from foreign exchange, all of those ones is not primary objective of your business. But income arising from that is classified as other income or other gains. Likewise, your expense, you have direct cost and operating expense, and any other thing other than that, such as losses, are considered expense also, but we consider them as other losses. Okay, Now, chapter 5, recognition and recognition. The general framework for recognition means at the point you decided to bring into your books any item of assets, any item of liability, equity, recognition borders on income and expenses. Anytime you are trying to bring them into your books by accounting for them, that principle is what we call recognition. It's what we call what? Recognition. That's why I simply said recognition is a process of you capturing for inclusion in your statement of financial position or in your statement of financial performance any item that meets the definition of any of the elements, be it an asset, be it a liability, be it an expense, be it an income, or be it an equity. Conversely, the recognition means you are removing any element from the account, and you remove on the basis of the nature of it. For example, when you remove an asset, you remove an asset when you no longer have right to the economic benefits. And when do you consider yourself not having right? One, if you sell the assets, you can't have right because you can't eat your cake and have it. Two, if you lose right by way of your right expiring. For example, you have investment in a bank and the bank went under, similar to the Bridge Bank that happened in 2009 to 2011. And as a shareholder, you lose all your money. Therefore, you no longer have a right. Therefore, that is it. Do you get it now? And all of this warrant the recognition, which means you no longer carry that asset in your books. Similarly, for liabilities, liabilities will be recognized if you no longer have obligation. When can you consider yourself no longer having an obligation? One, if the obligation has been settled, I've paid it, or the obligation has been discharged by order of court, or the obligation has been cancelled, or the obligation has expired. All of this will warrant me to what? To recognize a liability. Similarly, for equity, if you buy back your shares, you treat it as treasury shares by cancelling those shares as they are no longer in issue. Okay, that is that. But take note, okay, you can have what we call partial recognition, which means partial recognition means that you are not recognizing the entire asset because probably what has expired or what has been sold of the asset is just a part of it. Therefore, you can't recognize the whole, but you recognize the part. The same thing for liability. If I buy something from you, 10 naira, and I've only paid you 2 naira, I will only recognize 2 naira by reducing my liability from 10 naira to 8. You understand? Which means the recognition can be partly done over time. But recognition means you are bringing any new thing for the first time to join what exists before or what has not been existent before. While the recognition means you are removing what formerly exists in your books out of your books because settlement has taken place, right has been lost, or something has expired or is no longer required. Okay, that is that. Okay, and the basic principle of recognition is 2, which is the general principle. But as you move on to standard, there are specific principles for recognition for each category of item, inventory, PPE, revenue, and etc. But the general framework is this. 2 criteria must be met for recognition of an item. 1, it must be probable for an asset that economic benefits associated with it will flow to the entity. And for liability will flow out of the entity. And secondly, all of this can be reliably measured in monetary terms. And remember, if you go back to your basic accounting of monetary measurement, part of the concept of accounting, you say anything that cannot be measured in money terms, whether as naira, as dollar, as euro, are not accounted for. You might disclose them, but they cannot be accounted for, which means they cannot be recognized either as an asset or a liability or equity, income, or expense. And that is that for that. Okay. And also the recognition principle, as I've said earlier, if an asset, you recognize normally when you have lost control, whether in full or in parts. That's why I talk about partial recognition and full recognition. And for liability, if you no longer have present obligation because you have been discharged, it has been cancelled, or it has expired. Therefore, you recognize whether in full or in part. Okay, now let's move to chapter 6, measurement. Now, what is measurement? I always use issue of when you buy a cloth and you wanted to sew it, either with a tailor or with a fashion designer. Okay, some of you is a tailor you have, while some is fashion what? Designer. But you know, there's no difference between a gardener and a logba. Both is to sew clothes. Now, what am I talking about? Is that when you take your clothes to your tailor, what you expected is that your tailor will have to take your measurements. What then is your measurement? Is to take estimate of your size in order to have a perfect fit after sewing it. Now, let us now liken that to measurement for financial reporting purposes. Measurement in financial reporting is trying to find estimate of value for items or element of financial statements. What value am I going to ascribe to the assets that I'm going to bring into my books? What value am I going to ascribe to my liability that I'm recognizing in my books? What value am I going to ascribe to my equity, revenue, income, expense, etc.? And continuously at every period, again, when I look at my motor vehicle, what value does it carry as at today, as opposed to what it carries as at yesterday? All of these are the process of obtaining a value or an estimate of a value for an element of financial statement. This process is what we call measurement. It's what we call what? Measurement. Now, in what's it called? In financial reporting and under Conceptual Framework, the standard recognizes two bases of measurement. Two what? Bases of measurement. The first basis is the historical cost, which we are all familiar with. And that's why you find out that the convention in any financial statement disclosure is to say that this financial statement was prepared under the historical cost basis, subject to, which means the foundation is historical cost. And historical cost is synonymous to the transaction price as at when the transaction initially occurred or first occurred. And the difference is that that value is still what you are recognizing to date, regardless of changes in economic climate, situation, and time. And that's what we mean by historical cost. But because of the dynamic and nature of event in today's world, historical cost is not good enough or not sufficient enough for all categories of assets and liabilities. Thereby, argument comes in to say, what about some items that historical cost will not be a good representation of their value? Therefore, we now have the option to use current value, which means in account is either we report element at historical cost or at current value. Some, there is option to choose either, while some, there's no option. It's either it's going to be historical cost compulsorily or it's going to be what? Current value. Okay, and there are also some classes of assets or liability, as the case may be, that at all points in time, historical cost and current value will always be the same. Example is cash. What is the current value of cash? It is its face value. What is the historical cost? It's still the face value. Therefore, there's no issue of historical or current value when it comes to cash. because cash is cash, what it is. The value written on it is the value as at that point in time. You don't depreciate cash, you don't impair cash, except if the cash is stolen and that is write-off, it's a loss. You understand? Cash is that. But when we talk about things like PPE, it's now an accounting policy option to carry it at cost or at current value. But this current value we are even talking about are of three methods. Now, the three methods are as follows. The first one is fair value. Fair value, more or less, can be synonymous to market price of assets and liabilities. Even though by the time we get to IFRS 13, we define fair value extensively so that you understand that there are three hierarchies of fair value. Okay, starting from quoted market price to unobservable market price or inputs. Okay, we'll get to understand that later. We also have value in use. Value in use is the present value of the cash flow that is expected to be generated from an asset over its lifetime. Whereas alternative to value in use is the fulfillment value for a liability, which is the present value of the cash flow that's expected to be paid to settle the liability over its lifetime. Which means present value is the next to fair value. And present value for an asset, cash flow, is what we call value in use. Present value for liability cash outflows is what we call what? Fulfillment value. Now, the last one is current value. Current value, more or less like, is an entry value synonymous to fair value, but fair value is an exit value. Exit value means that the price that you pay, do you get what I'm saying now, to settle your liability, or the price you receive to sell your assets at a measurement date among market participants. Okay, but replacement cost is an entry value, which means is the price you pay to replace your asset in similar condition of the old assets. Do you get what I'm saying now? Okay, and we're going to see that as times move on. Okay, now that is why in this table here, I try to summarize it. Historical value is always entry value because it's your transaction price at every point in time. Okay, but the difference between is that it doesn't change regardless of passage of time. Okay, fair value is based on market participant and it's always exit value because it is the price you receive to sell your asset or the price you pay to transfer your liability or to settle your liability among market participants. Now, the other one is the value in use. It's simply the present value of your future cash flow of an asset, or fulfillment value, which is also an exit value, the present value of the cash flow that you use to settle your what? Your liabilities. While current costs, okay, for an asset, I've told you whether assets or liabilities are entry value, which means what you have to pay to buy a new asset in similar condition with the old asset you are replacing it with. Okay, and liability, what you also receive to more or less incur an equivalent of your existing liability in today's time. Okay, but you can also read further on that. Okay, and I've broken down scenarios of various valuation consideration for assets, liabilities, and equity. Now take note, I told you about equity, that equity is only measured once in its lifetime. Why? Because equity going forward will be measured by residual interest in the assets after deducting the liabilities, which means it's not subjected to remeasurement. It's only measured once in its lifetime. And let's see why. The total carrying amount of equity is not measured directly. It equals the total carrying amount of all recognized assets less the total amount of all recognized liabilities. Because the general purpose financial statements are designed to show an entity's value, the total carrying amount of equity will not generally equal to the aggregate market value of equity claimed on the entity. The amount that could be raised by selling the entity at a whole on a going concern basis, or it will not reflect the amount that could be raised by selling all of the entity's assets individually and using it to settle the liabilities individually. There's a technical note I emphasized here. I said, although total equity is not measured directly, it may be appropriate to measure directly the kind amount of some individual class of equity. Nevertheless, because total equity is measured as a residual, remember, is a net asset, at least one class of equity cannot be measured directly, which means even if you can measure other components directly, at least one will not be measured directly, and that one will surely be retained earnings. Okay, similarly, at least one component of equity cannot be measured directly. Now let's move to chapter 7. Now chapter 7 borders on presentation and disclosure. Now presentation means the order to which we present information or we provide information for the use of the stakeholders or users of financial reports. For example, IS1 presents the order to which financial statements will be communicated to the shareholders and other stakeholders. Now, similarly here, we consider that financial reporting is a tool for communication. Therefore, the orderliness of the presentation, the sequence of the presentation, and other things is sacrosanct and paramount to the understandability of the information contained therein. Therefore, what happened is that in accordance with the standard, effective communication of information in financial statement makes that information more relevant and contribute to a faithful representation of an entity's asset, liabilities, equity, expense, and income. And therefore, you'll find out that when you present information in a manner that is understood, that can be compared with another information, it makes meaning to the users of financial statements such that it forms a basis of making decisive decision, or what we could call a sound decision. Likewise, your level of disclosure, as earlier said, will more or less increase the depth of reliability, increase the knowledge of the users, and provide sufficient information that will make the users have better understanding and appreciation of the information contained therein. Finally, okay, now when you present information, the standard told us that we must consider these three things. Classification of information means that you must be able to group information based on similar attributes or characteristics, so that if you are disclosing information about assets, group assets separately from liabilities. Even within the individual classes, try to more or less subgroup them in such a way that the information provided will be more meaningful to the users. Secondly, offsetting. The standard says that we should more or less, as far as practicable, try not to offset an element of asset with liability, income with expenses, except if certain conditions are met. You can only offset if there's a legally enforceable right to do so. And secondly, even when there's a legally enforceable right, you can only offset when that asset has to be realized to settle the liability, or the expense is incurred directly as attributable to the income to reimburse that expense. For example, when you have insurance claim as an income, you don't need to show it separately from insurance loss, because the insurance claim is primarily an income to restore your loss. Therefore, you have to offset that. But when you earn revenue, I say, but I incur that cost to earn revenue, therefore I have to net it off. The position of the conceptual framework is that no, you understand? You have to show them separately. Lastly, aggregation. Aggregation means that though it will be nice to show all information on an individual basis, but when those information on individual basis are not material enough, it is better advised that those information are aggregated. For example, why do we aggregate some expenses and call it management expenses or other operating costs? It's like coming to your financial statement and you are saying lightning, petrol, diesel, all those things do not add any value. They are utilities which can be grouped as one as utility. It doesn't help the users. It's going to be an information overload of just breaking things down up to your level of toiletries and all sorts of things. Therefore, what you need to do at any point in time is to consider the basis of aggregation of information for better information management. Okay, and finally, we come to the concept of capital, which is chapter 8. What is capital? Capital is simply what? Capital represents your initial contribution to a business as a startup. The second meaning of capital is that once you are no longer a startup, you are now an ongoing business, capital now starts to represent your buffer, start to represent your shock absorber to absorb any shock in your business operation as a result of losses, economic event, or otherwise. And thirdly, capital starts to serve as a basis of your expansion and growth and sustainability, which means capital metamorphose from a startup as initial investment to a buffer and shock absorber in the period of operation and maturity, and also it serves as a growth mechanism or expansion upon your retention over time. But the question then is this: if you understand and appreciate what capital is, based on what we have just explained, it is now paramount for us to maintain such capital, which means if you value your car as a tool for your business, imagine you're into transportation, your car is your life because it's your business. What do you ensure you do to sustain your business is to always maintain that car adequately, which then means that capital, since we appreciate what capital plays as a role over the life cycle of a business, how then do we maintain capital? How well established do we maintain capital? And that leads us to capital maintenance concepts. There are two concepts of capital maintenance. We have the financial concept and we have the physical concept. Okay? Now, the financial concept is measuring profit as a tool of maintaining capital, given that profit is only earned and may be available for distribution if you consider the value of your net asset at the end against the value of your net asset at the beginning. And you find out that the value of your net asset at the end is greater than your value of your net asset at the beginning, without considering the effect of new capital injection, which means if there's no new capital injected into the business and your net asset at the end is greater than your net asset at the beginning, it then means you have made a profit, given that there's no new capital introduced. Or if new capital is introduced, you will have removed that new capital from your net value at the end. And once that net value at the end, after that still exceeds at the beginning, it means you have made profit. That is how profit is defined by way of financial concepts. But profit is defined alternatively by physical concept, looking at the productive capacity or the operating capability of a business to say, if my capacity level at the end is greater than my capacity level at the beginning, given that there is no injection of new capacity or capital, therefore, any excess capacity of the end over the beginning is a profit. Since we all agree that profit is a tool for maintaining capital. Okay, now, but the financial concept has two methods under it, or two methodologies. One is the nominal concept. The other one is the real concept. Now, what is the difference? The nominal concept does not consider the effect of inflation, whereas the real concept considers the effect of inflation. What is inflation? Inflation is a general rise in price level. General rise in what? In price level of goods and services. And therefore, if inflation exists and is not taken into consideration, it is a limitation to a nominal financial concept of capital maintenance, because it doesn't adjust for inflation, and therefore, over time, your capital will be eroded by loss of purchasing power. But to address that shortcoming, the real concept now says, adjust for the general price index, which is synonymous to what we call consumer price index in the industry, and which is the average price increases of commodities and services over a given period, which is usually measured on a year-on-year basis. Okay, if you adjust for general inflation in the measurement of your profitability based on the capital maintenance concept, that means you are talking about real financial concept of capital maintenance. Now, the physical concept primarily deals with adjustment for inflation, similar to the real concept under financial concepts. But what is the difference is that the physical concept only deals specifically with specific inflation of commodities that affect your business, which means if your business is into items of petroleum supply, inflation rates relating to petroleum supply is what will be adjusted for, not the general inflation rates. You can say that, which means one is dealing with specific inflation, the other is dealing with what? General what? Inflation. And that needs to be taken into consideration. Now, the concept under financial, which we talk about nominal, the accounting methodology is what we call historical cost accounting, which is what forms the base of our accounting today. Your IS1 is presented under the base of what? Historical cost accounting. But for critical evaluation, we can also adopt what we call the current purchasing power accounting, which speaks to the real aspect of capital maintenance, financial concepts. And the third one is the current cost accounting, which speaks to the physical concept of capital maintenance. Now, to wrap it up, I'll quickly show you a practical illustration of what it is. Now, how do you make such inflation adjustments? I'll read this question. Farasimi starts a business on 1st of January 2018. Farasimi sole shareholder contributed capital of 1 million naira. Farasimi purchased one item of inventory for 1 million naira and sold the item of inventory for cash for 1.4 million. As at 31st December 2018, the replacement cost of the same item of inventory is 1.1 million naira, the equivalent of 10% specific inflation rate. General inflation during the year was 7%. The question then is required, calculate the profit for the year and set out a summary statement of financial position as at 31st December 2018 under the following capital maintenance concepts. A, physical capital maintenance. B, financial capital maintenance. And the B has two methods under it. Historical cost accounting, which is for the nominal, and current purchasing power accounting, which is for the real. Now, what is the solution? I will explain. Regardless of the concept, you sold your goods for how much? 1.4, and that's what you could see here. Okay, you sold it for what? 1.4. Okay. I'll see whether I can. Okay. Okay, you sold it for 1.4. Let me use highlighter. Okay, you sold it for 1.4, regardless of the methodology. Now, what is your cost of sales? What you sold for 1.4, you bought it for 1 million. That's why your cost of sales is 1 million all through. Now, do you require inflation adjustment? Is a function of which methodology? Now, for historical cost, there's no inflation adjustment based on this principle. But for physical concept of capital maintenance, as at the time you are selling the item, if you are to replace that item, you'll have bought it for 1.1, But luckily, you bought it some time ago at 1 million, which means you are not saying that, wait, forget about how much I bought it before. If I'm to buy it now to sell, I will have bought it at 1.1. Therefore, the market has moved by how much? 100 naira. Therefore, you adjust for this 100 naira. Do you know why? Because if you are to go buy and stock your goods, you can't stock it at 1 million. You stock it at what? 1.1. So that you won't have finished the profit of this 400. And you have your capital back at 1 million, and you go to the market, you can't restock, which means you quickly adjust for the market increases of 100, so that the profit you have is 300. Now, where does this 100 goes? This 100 goes in maintaining your capital. Can you see here? I'll take it. Which means your capital is no longer 1 million. It is 1.1 because it is now inflation adjusted, so that the loss of purchasing power has been compensated for and recognized. Do you get what I'm saying now? Which means your cash is 1.4 you receive, your capital before was 1 million, but plus the inflation adjustment is now 1.1, and your profit is 300. Now, this is your profit, you can spend it 100%. You see out sufficient capital to continue your business. That's what it means. But if you go by way of current purchasing power accounting, which is a real concept under financial concept, you are still going to adjust for inflation, but using the general index of 7%. Remember, the general inflation index is 7%, the consumer price index, which is the average. What it means is that they've considered all commodities. Some will have inflation of 2%, some will have inflation of 10%, some will have inflation of 15%. When they average it, it is 7%. Now, using 7% will give you 70. And that 70 will increase your capital by 70 for loss of purchasing power. And you have 330 to play with at your share of what? Profit. You can say that. But the shortcoming of general purchasing power price index is that it's either it understates your loss of purchasing power or it overstates your loss of purchasing power. For example, for an item which increases in value by 2%, but the general market increased by 7%, you will have overstated the loss of purchasing power. But for an item that, for example, at 10%, but the market says 7%, you will have understated your purchasing power. You can see that. But at least it's better compensate for historical costs, which means what capital maintenance concept is saying is that inflation adjustment should be considered, especially for economies that have higher inflation rates, should be considered in ascertaining what form of capital maintenance do they require and what amount of profit do they have as a real profit for distribution after taking effect of adjustment for inflation. On that basis, I think we'll come to the end of the class. And you can read this material on your own. And once I'm going to send you the material I've written upon and share it with the class. Thank you very much, and God bless you.